by Exponent Investment Management, and we're going to chat today about the tax treatment of option premium income for Canadian investors. This video is actually going to present an interesting facet of how option income can help you in terms of maximizing your after-tax income as a private investor. My name is Benoit Poliquin, and I'm the lead portfolio manager at Exponent Investment Management. So who is Exponent Investment Management? We're an Ottawa-based firm. We specialize in generating income for our clients. So we'll focus on global dividend income, if you will. So Canada, the US, Europe, and other international countries. And we'll also use, for the clients that want it, we will use option sales in addition to this portfolio. We exclusively work with private clients. We do not work with institutional clients such as pension funds. What we effectively do with our clients is we help them transition from their active business or professional income into a passive dividend investor income. Who might you be? You're a person or a group or a family that obviously has excess capital. You're looking to protect and improve your financial situation. And you will need income, whether it's now or eventually in retirement or later on. And you're also looking for something that's simple and easy to understand. So how do we do it? First of all, we start with companies with an ability, a history, and a policy of growing their dividends. Notice we didn't talk about the highest yielding dividends. You may or may not know that over 50% of the long-term return of equity investors actually comes from dividend income in the form of the income, the reinvestment of this income, and the growth of the dividend income over time. While most of our Canadian competition will focus on Canada only in terms of the dividend stocks that they may or may not want to include, we'll actually go further and include US names, European names, and other international markets as well. It's important to remember that Canada represents only 3% of the world's economy. So why would you want to forget or simply ignore 97% of the world's economic activity? What we'll do for some clients who need more income or are looking for a tax advantageous income, if you will, we will augment the dividend income by selling either calls or puts on an underlying stock portfolio. So let's begin by defining an option. We've talked about in the other 3 videos that you may or may not have seen on our website. I would invite you to go and take a look at them if you need a refresher course. Effectively, an option is a derivative security. In other words, the price of the option is derived from price of the underlying stock. The equity option is the right but not the obligation. And that's very important to remember. It's actually the most important concept to understand when we talk about options. So it's the right but not an obligation to either buy or sell, depending on which option you buy, an underlying stock at a defined price and by a certain date. There are 2 kinds of options. This is where most people get confused, if you will. There's the right but not the obligation to buy something, which is a call, and the right but not the obligation to sell something. So you might buy a call, you might sell a call, you might buy a put, you might sell a put. You can do either way. In our case, we focus on selling options. That's what we focus on, mainly because options have a finite life to them. Remember, a certain date and a defined price. So whatever happens, it needs to happen within that defined date. So theoretically and actually, option prices depreciate over time, and we want to take advantage of that. We're focusing today on the tax aspects of option selling, and we're going to focus on covered calls. So here we have an example. And let's say it's a stock that right now trades for $24.75. So the red line is your profit and loss diagram. So obviously anything above $24.75 is a profit, anything below is a loss. And when you're selling a call that's covered by owning the shares, effectively what you're doing is you're giving up this area right here in exchange for this option premium, this income that the option buyer will give you. So in our example, we have the stock that trades for $24.75, and let's say it comes due in the next 75 days, 74 days out. Options have fixed maturities to them, but this is obviously just an example. And let's say that the option buyer gave us 32 cents for our troubles. So these are the parameters of this option trade. We own a stock. We might have purchased it now just prior to selling option, or we might have owned the stock for a long time, but our cost price is $24.75. So let's go through the tax implication of this. Very important to remember, capital gains and option premiums are the same. Okay, so usually in a capital gains, you have to actually wait until you sell the stock higher than what you paid for it to collect your capital gains. In this case, when you're selling your option premium, you get the money up front, or 32 cents, if you will. And only half of this 32 cents is included in your taxable income. And whether it's a personal tax return, if you will, if you're investing personally, or in a holding company, or in other tax structures that your tax professional might have set up for you. And oddly enough, capital gains have this tax advantageous because they're associated with higher risk. But in this case, the capital gains comes to us up front when we sell the option. So I remember I said 74 days. So we can do 74 days, and this basically means that we can do this 5 times in our year. So we collect our 32 cents 5 times. And so that's $1.60, which is quite a nice yield. We can remember we are paid $24.75 for this particular stock. So this $1.60 on a pre-tax basis equates to $24.75. Equates this $1.60 on an annualized basis. If we divide that number by $24.75, it equals roughly 6.5%. So if the stock does nothing and we never get called away, meaning the stock never reaches $26 every time we do this, we will get 6.5%. And let's say that our stock also pays us a dividend, and this dividend would be the order of 3.4% on our $24.75. So that's 84 cents. Sorry for the penmanship here, but so 84 cents is our dividend, and we add this to our $1.60, and we get a total return of $2.44, which equate basically 10%. So we have a stock, even though nothing happens to the stock, the next year we buy it for $24.75, and a year later it's still $24.75. If we sold cover calls on it, all else being equal, and we are getting 32 cents 5 times, we will make 10% on this option, on this trade. Remember, only half this $1.60 is taxable. So what does this mean? It effectively means that we will only pay, let's just say you're in a top marginal rate of 45%. So on your 80 cents, if you're going to pay 45, you're going to pay 36 cents in taxes. You're left with 44. But we also add our 80 cents that we didn't pay tax on. So that gives us $1.24. So our after-tax yield on this option trade for the year is a very alluring 5%. So even though on the pre-tax basis is 6.5%, we only, on an after-tax basis, the yield is 5%. It's a great example here of how option premiums can help clients in Canada generate more income and have this income be much more efficient from a tax perspective. So the obvious question is, why isn't everyone doing this? Well, the financial services industry is not a big fan of work. It is a lot of work. You might be doing this on a portfolio of 30 stocks, and typically, in our experience, about 7 to 10 of these stocks will be called away in a normal market condition. And so it takes a lot of research to find stocks to replace these stocks, the ones that get called away. From a tax perspective, you can't capture the capital gains exemption, the 50%, in a fund or product, because when you buy an ETF or a mutual fund, you're buying shares in the product. You're not buying shares in the underlying securities. And so most advisors actually prefer selling funds nowadays, and they're not either trained or interested or have any desire to create portfolios for most people. So, and really most people are not even, in addition to this, most advisors are just not familiar with the option strategies. Interestingly enough, Most do-it-yourself investors, and I have the data for the US market in 2013, TD Ameritrade, one of the largest, if not the largest, discount brokerage arm in the US, 40% of all their trades were option trades. So there's a paradox here where most advisors aren't embracing call selling or collateralized put selling, while the do-it-yourself investor is. So it's a fascinating trend that we're seeing in the industry right now. Pension funds, on the other hand, in Canada are some of the largest players using this strategy, which is covered calls and collateralized puts. The reason they do it is because it generates a lot of cash flow. And as a pension fund, you need cash flow because you effectively have to make pension payments every 15 or 30 days. So liquidity is very important. So to recap, the income when you're ready to retire or in retirement is part of the total return. The other part is appreciation or capital gains, if you will, in the conventional sense. But the income is the certain part. So when you're planning, what you want to do is plan around the certainty of your income. Option premiums, while not guaranteed, or certainly can be modeled out. In our previous example, you can make a very profitable 5, 6, maybe 4% on an annualized basis from capital gains that comes in over and above your dividend income. So obviously the more income you have, and if this income is certain, the better it is for your lifestyle. The goal is to generate this income in a tax efficient manner, which obviously makes sense. This is where most people will get in trouble with option selling, is that option prices are based on what's going on in the underlying markets. And so if you have a stock that's very volatile, moves up and down a lot, you will have very interesting or very profitable option trades to make, but they're not quality stocks, which you would not want to own anyway. And so it more or less defeats the purpose. So we only sell options, and we only sell the options that we own where we own the underlying and sell the call against this position. Or we're looking at a stock that we want to own, and we would like to own it at lower prices, and are willing to effectively put in a limit order and get paid for this limit order. Thank you very much for your time. If you have any questions, don't hesitate to email me or give me a call. The numbers are below. Or if you need a refresher on the basics of options, please visit our website, and you will see the first 3 videos on covered calls and put writing. I am Benoit Paliquin for Exponent Investment Management. Thank you very much for watching.